What's going on, everybody? Today marks the 11 months of investing $10 a day until we hit 10K challenge. Essentially, we're going to be going over the portfolio, going over how we've been doing so far, and you know what, just showing off the returns and I guess some losses. Recently, we've had a little bit of market disruptions and the market's been going down and whatnot, but you know what, we'll show a little bit of that as well. Essentially, the reason why I started this investing challenge is because we saw a lot of billionaires and hedge fund managers that are making crazy amounts of money, and it seems like all the poor people just can't get their hands on that. So I thought I might as well try to do an actively managed account with only $10 a day. I know it's not the same as or as simple as just putting money into an ETF, but I thought I might as well have some fun. Make a spreadsheet where I can calculate intrinsic values and essentially buy the stocks that will hopefully give me the best returns. But let's jump into the portfolio and see what it looks like in here. So jumping straight into the portfolio, as you can see, today was that really big red day followed by last week. It's not looking the greatest, but we've been making calculated buys and sells throughout the year. And you know what? It's been fun. Although we haven't really doubled the S&P 500, which was kind of the goal, we've definitely at least matched the S&P 500 performance. And as you can see here, it looks like we've got a 7.5% gain over the last year. But with a weighted annual return, we're actually looking at around 16% annual growth. Just going through looking at some of our biggest holdings, we've got Ulta, Alibaba, Intel, Comcast. Intel is actually one that we just recently started buying. It's had one of the biggest drops out of all of our stocks recently. And this is quite a big turnaround play, but as you can see, we've got a 12% diversity here in the portfolio with Intel. We've got Comcast and PayPal down here. JD.com, CVS. So as you can see, we kind of have been holding all of these positions at around the $300 level. And that's kind of what I'm trying to keep it at for now. For Ulta, I think I might keep it at the $500 level. If it starts dropping more, I may actually raise it to about $600 for that position. The Alibaba position is essentially break even. It hasn't really done much movement. We had this big spike over here, but other than that, not much movement over the past, I would say, 6 months or so. So Alibaba is just kind of there as a hedge against the US market, because it seems that whenever US markets go down, the Chinese stocks are going up, or they're at least staying stable. The other Chinese stock we've only got one more, which is JD.com. Based on our calculations, JD.com's got the best return potential compared to Alibaba. We've down almost 9% on this position, but it has had a crazy drop over the past 3 months. I may continue loading this up if it keeps going down, but other than that, I'm probably sticking to around the $300 level if it just stays at this price for a while. But as you can see, we're down about, or the stock is down about 40%. Overall, and over the past 5 years, it's just about break even, with around COVID time, after COVID time being the crazy spike on this one. So I'm deciding to just keep this one in just for the US-China diversification, which is not really diversification, but you know what I mean. But CVS is another interesting one. CVS is one that a lot of hedge funds have been buying. Interestingly enough, this one is not calculated as a crazy return on investment or calculated potential return, because this stock doesn't really have that much growth potential, at least based on analysts. So looking at this, we go down here, which is kind of awesome that Robinhood added this. We can see the hedge fund purchases. So we usually use QuickFS and Dataroma for our stock research. And Dataroma actually has a lot of the hedge fund and institutional investor reports. Essentially, you can see exactly what stocks they're buying. But it's kind of nice that Robinhood added this recently. So you can see what stocks are getting bought up by hedge funds. But as you can see here, since Q1 of 2023, hedge funds have been loading up CVS. And this is, a little bit after since we started buying, but I love to see that they've been loading up recently. So I don't know if I'll be buying too much of CVS or adding too much to the position, but as you can see, we're down just 4% on that one. And you know what? It's potentially going to trend up from here. It might have bottomed out, but we're always at risk of market risk. So if the entire market ends up crashing, even the most undervalued stocks may potentially go down with it. But when we have an idea of what stocks are severely undervalued, that's a great time to take advantage of a market downturn. But going down here a little bit further, we've got Paycom, which is showing a pretty good return potential. We were up about 18% on it for a little while, but over the past week or so, we trended down just a little bit. So we're sitting at about 8% return. But this is another one that's just quite interesting. Not very many people, are saying anything about this stock, but the financials look very good. A couple of you guys in the comments have mentioned that Paycom might be a terrible investment, but then a couple of you guys maybe mentioned that Paycom is potentially a sleeping giant. So, I'm just going to trust my numbers, trust the calculation with Benjamin Graham's formula, and we'll see how it goes. Over the past 5 years, it looks like it's down about 31%. So, if we're getting a good calculation with Benjamin Graham's formula and we're sitting so down based on 5 years ago, it's kind of making me want to buy more of it. But we're going to sit at the $300 level for now. Now, as far as Charter Communications, this is another one that hedge funds have been buying up little by little. As you can see here, the Robinhood retail traders have been selling it off. But for hedge funds, we've had somewhat stable buy-ups, I would say, with the most recent big purchases being done in Q1 of 2024. But we started buying this up, I don't know, about 6 months ago, grew a position. I think we got up to about $400 position, and we ended up selling $100 just so we can throw some of that profit into other companies. But I think I'm just going to hold here at this price and see if it trends up over the next 6 months. As you can see here, in the last 3 months, it's up 36%, and it was at some point up 44% almost. So definitely a turnaround play there whenever I started buying in this huge dip here. But still, based on its 5-year, it's essentially break even. And over the max, it's looking like a really tasty dip. So I'm keeping that one for sure. And going down a little bit further, we've got Disney. This is one that we've been buying slowly up. Some of you might remember this is one that we had a pretty decent position on. If we go back here in history, all the way back here, we ended up buying up in a huge dip at around under $90, and we ended up selling at $117 per share. So I believe that was about a 30 or 40% flip, but it's trended down since then. I believe we sold it just about at the top, and it's getting into that buy territory. So we'll be slowly loading up that position and try to get it up to the $300 level, which might take a little bit doing only $10 a day. But you know what? We've built up all these positions with $10 a day. We've built up this amount of money over a year or 11 months doing $10 a day. So it'll happen eventually. As far as the other ones, they're tiny positions. Starbucks, I don't know if I'll be growing the position. Southwest, I don't know if I'll be growing the position. But Meta's a really good company. Their earnings growth is incredible. I really, really want it to just keep going down with all this market instability. I would really want to take advantage of Meta specifically. And you know what? Seeing it drop down to under $400 levels would probably make me start building that position up slowly. But as for at these levels, I think it is undervalued technically, but it's not undervalued to a point where I would want to load up on it, because I want to be buying companies that are severely undervalued so I could essentially raise my chance of getting really good returns over time. And guys, we got to make sure to stay calm and collected during these market downturns. I know it's easy to make buy and sell orders based off emotions, but we've got to, make rational decisions with our investments. Sometimes we got to hold, sometimes we got to sell, but we can't base it off of what everybody else is doing. We have to actually have a method and make sure we're sticking to it. As you can see, the Robinhood app is essentially turning off overnight trading. And that's probably because of the very, very high volatility recently. And these are the types of things that, you should consider, but they should not worry you to the point where you're thinking of liquidating all of your assets. We got to make sure we stick to our process, we stick to our valuation methods, and we see whether investments have good potential returns or if they don't have very good potential returns. And we buy and sell based off that, not off the emotions that we feel. But anyways, guys, I really appreciate you stopping by, and I hope to see you at the 1 year $10 to 10K challenge update, and I'll see you in the next one.